All right. Here we go. So, Pankaj, how are you doing?
Good, man. How are you?
Not bad. By the way, everyone who doesn't know out there, this is Peter, one of my co-founders from Funabulous. So today he's in town again or visiting. Hopefully he'll be back soon, but we'll have a chance to have both of us on the show today.
Welcome to the show, Peter.
Thanks for having me.
So let's jump into it. So welcome everyone to the next episode of The Raise. So The Raise is going to be, or will be, and is a real-time sort of interactive series on how to raise money. So you'll actually be joining Peter and I and our other founders on the journey of actually trying to go through the process and all the ins and outs. This isn't a workshop or a seminar in any way. It's really a behind-the-scenes look at the research, the decisions, the questions, and the actions that we're going to take while raising money for our next startup. It's a new company called Funabulous. And we hope that by letting you see sort of everything that we're going through, that you'll be able to understand the process for yourself and hopefully follow along and emulate or borrow from this to power your own efforts.
And I'm Pankaj. I'm going to be playing the role of mentor and investor, helping Greg, Peter, and the rest of the Funabulous team trying to get through this fundraise. The big difference between what I'm going to be asking as an investor is that I'll also be sharing some of my thoughts and insights on the best way to answer questions that investors might be asking Greg and the team. And most importantly, we want to know your questions. So, ask them in the comment section on our website at foundercraft.com or email us at raise@foundercraft.com. So let's jump right into it, Greg.
Absolutely. So let me get this going here. We're testing out more fun stuff. Sorry, guys. Takes a little time. So this episode is episode 102. And we're going to be talking about basically today, like how much should we raise, right? So I think last week we looked at really understanding like if it maybe was an appropriate time to raise. I think we sort of got a half nod about yes. So I think we're willing to evaluate that and continue to evolve. And I do think like it's important to remember that this is a moving process, right? So like asking that question is a question you're kind of constantly asking yourself. And then over time, as you do get more traction or make more movement, you will find yourself getting closer and closer right to, I think, that time where you will need to figure it out. So the biggest question, I think, after that then becomes, well, like how much money should you raise, right? And I think a lot of people suffer through the process here because they don't necessarily do a good job of coming up or thinking through like why they need to raise money, what they're going to use it for, or anything like that. So I put together some data here that I'm going to share, like some of our thought process about like why we think how we arrived at sort of the numbers that we actually believe we want to raise.
Okay, fantastic.
In our mind, we believe that this is what today is called pre-seed funding, right? So I don't know. The rounds are constantly moving and the names are constantly moving. I think when we did our seed at Shoot, it was like 2.7 million. I think that's still normal now for a seed or something like that. But like 10 years ago, like an A was what we call a seed, right? Or yes, everything is power shifted over a bit. So we do think, our target for raising is about either $250,000 to $750,000.
Yep.
Now we also said, like, we sat down and we said, well, like, what are we going to use the money for? Right. Yep. And so these were some of the things that we came up with. Mm-hmm. Like there's a bunch of incorporation fees, payment processing, like some initial early taxes. There's the legal paperwork and stuff like that. Like we're planning to use Stripe Atlas to actually do just the basic incorporation. But I think it still costs like $500 or something, right?
Yeah, it's not a big expense.
It's not a big amount of money,
right?
But and obviously we're going to fund that out of our pockets anyway.
But you're also going to need a lawyer to like actually sit down and come up with your vesting agreements, employment agreements, all that stuff is not, something that you can use off the shelf necessarily. So
that's right. Yeah. So there is some legal and stuff like that, I think, like built into sort of the notion of this as well. Yeah. We are not going to pay ourselves full salaries, but we do want or need sort of like a working sort of stipend, I think, to sort of like support us. There's 3 of us, potentially, hopefully 4 of us, in the long term as we sort of move through. But even here, we're our goal is to also from like when we look at the outset or like our future, we're hoping not to necessarily raise a lot of money. Actually, we'll have some questions for you later, Punkage, about like, how to handle it or broaching that, like setting expectations and things like that.
Yeah.
We do have, obviously we're a SaaS platform, so there's going to be some infrastructure and some hosting stuff. Right now, it's like $40 a month or something. It's like a fairly trivial amount of money, but as we get users, that those numbers will go up, and depending on some of the choices we make, that may change as well. There's some business development stuff that we do plan to do. So we, because we've been in the space for quite a bit of time, we have a lot of access to some relationships and partners who have been waiting for us to deliver our product. And so we want to get to the point where we can follow up with those folks, potentially go and sit down and meet with their teams and get those deals done, because I think that gives us a way to bolt on, hundreds of thousands of actual partners. So not like extensive travel, but I do think it is a little bit of, a little bit of here and there, just being in terms of like openness about what we expect to spend money on. And then of course, the earliest money is actually, and I don't know if this is weird, but some of it is the money is funding to fundraise with, right? Like, so, we anticipate we likely will raise some money maybe from New York, San Francisco, and obviously probably here in Denver where we are. And so that involves a little bit of getting here or there and whatnot. But in general, we don't see a lot.
Yeah. And that falls into the travel category, right? So
absolutely. Yeah.
And, one of the things that I've seen in the past is, people will put together a expense plan, and then they'll look at it and say, hey, this is where we're going to spend the money. It's probably fair to say that you're not going to spend all the money in the categories that you allot that money today, but you'll probably spend all that money that you're going to raise, right? But you might say, hey, you know what? We're raising more money in Denver than we thought we would, so we don't have to travel to New York. That means our travel budget just went lower than we expected, so we can use that money for more advertising.
Yeah.
So,
what is this enough granularity just for folks out there, or like, do you think? Is this better expressed in a different way, like as a spreadsheet, or, like, what are your thoughts, I guess?
Well, I think for you guys, for the founders, whatever makes sense to you, and like, you can sit down and say, all right, well, we think we're going to spend about $1,200 on corporation fees, right? We're probably going to spend another $5,000 on legal fees, right? After having talked to a lawyer and getting some sort of ballpark figure,
right?
We know that we're going to be spending infrastructure right now about $100 a month, and that's going to go up to about $300 a month. So let's budget that in, right? And basically, what I think you should be doing is extrapolate how much money you're going to be spending on each of these broad categories over the next 12 or 18 months, or however long you think that the amount you're raising for is going to last you. Right. So if you're raising $250K and you think that's going to last you 12 months, then sit down and within these categories say, well, how much do we really think we're going to be spending on all of these things over the next 12 months? Right.
Right. Yeah. So definitely we should go a little further out.
Yeah. I mean, you guys should know that, right? It's not necessary for folks that you're pitching to know all of that the day that you pitch them, but as deals move forward, some investors might want to dive in a little bit more and say, well, why are you spending $40,000 in corporation fees and legal fees? That doesn't make any sense, right? So if you have like a spreadsheet where you've actually modeled all this stuff out and said, okay, this is how much we think we're going to spend on some of these things, and over time, as we add on more people, or we think we're going to launch the product, we might start increasing our BD and marketing spend. So, you have a structured way of looking at where you're spending that money. So this is a good place to start. Next step, I would say, is like put together a spreadsheet and like lay all this stuff out.
Good to know.
Is there like a recommended template for the financial spreadsheet? Or?
No, I mean, there's no recommended template. There's tons of examples out there. I might have one or two sitting around somewhere, so I'm happy to share that with you guys also.
Cool.
But yeah, there's plenty of simple things out there, because really there's not a lot of things. You just want to have a category, right? And what you think you're going to be spending over a certain amount of time. So whether it's 12 months, 18 months, 24 months, you can just extend that out. So it's not a big deal.
Right. Great. Yeah. And that's the most succinct way of seeing, like, and I think the big bucket categories is still like basically like salaries and infrastructure. Like the other stuff is fairly incidental.
Yeah.
Unless you are doing things that maybe have other kinds of costs associated with
Right. Well, I mean, let's look at BD for a second, right? And infrastructure. And once you launch and you have a user or customer that needs you to spend some time with them, you might be spending more time on travel, right? And more money on travel. And if you're live and you have customers using it, your infrastructure costs are going to go up also.
Yeah.
Right. So, they may not be paying you. You might be doing like a 60-day trial, getting onboarding. So you're eating that infrastructure cost until they start paying you.
Yeah.
So, those are things that you can account for when you have that spreadsheet kind of laid out.
Yeah. Perfect.
And you can align it up with your product plans also, right?
Right. Yeah. And actually we're gonna get to that, I think, in here now as well. So I think moving forward, we sort of like in our minds have laid out sort of these three kind of what we call quote unquote milestones, like for our own fundraising effort. We sort of imagine like something early, which is, like aiming for something in the round area of like kind of like 50K, like from, friends and family, some, founders that we know, and maybe even like some of our previous investors who are angels. I think in our mind, this is like an early thing. It's more, as Peter said, it's more they're investing in us than it is they're investing in like what the opportunity is per se, right?
Yep.
I think we want to expand that to get to about 250K or so, which I think would give us a whole bunch of more opportunities. And we'll talk about that, like where that goes, I think, from there. And then, our broad goal would be to probably get to like about a 750,000. And I think the reason we looked at it from this point of view is also that there's some like some relationship building and legwork kind of in each of these different discrete audiences. And so give us some feedback, I guess. Is this sort of like, are we right? Like, are these kind of the people participating like at these like numerical markers and like we sort of put some time around it?
Yeah.
Just in terms of not like whether or not we'll be ready, just a kind of, I guess, like of how long it will take like for it to complete.
Yeah. I mean, look, I think friends and family and folks that know you really well, those are the quickest ones to get a yes or a no from. Right. Whether they wire or not, that's a different story. But at least getting to a yes or a no, they'll tell you pretty quickly, like, Greg, here's 5K, here's 10K. Right. So you could do that pretty quickly. Right. And that gives you a little bit of breathing room to kind of get to a larger round. Right. The friends and family and angel round, they kind of like sometimes come together because, there could be overlap between them. So you might have, let's say, a friend, a close friend that you've known for a long time who is an active angel investor and be like, yeah, sure, Greg, I'll come in, I'll put in 50K. Well, okay, wonderful, right? So, there is some overlap sometimes in that. So I don't think it really is necessary to kind of break it up into a distinct round or anything like that. I think the way you're looking at it makes sense because you're saying, all right, we need 50K right now to kind of get us to a slightly larger amount of money. And we know realistically between Thanksgiving and New Year's, nothing's going to happen. Yeah. So if I can get, 50K quickly right now, I can start planning and preparing myself for the real hard push beginning in January. So that makes sense. Now, I think your 250K could actually be larger. You can probably push that up a little bit. Maybe to like 350 or something like that, 350.
Why is that?
Well, partly because of what I was saying before. And this is because of you, not necessarily what's the general rule, right? You are a founder who has relationships with angel investors and VCs. You have successful exit in the past. You have investors in a previous company that have made money. So that could mean that some of these folks will put more money in than they would into another startup. So instead of putting 5K in, a founder might put in 10K, right? An angel investor, instead of putting in 10K, might put in 25K. right? So your numbers could become a little bit larger just because you're going after people that really know you and have relationships with you, right? And they are active investors to a large degree. So that might push the numbers up. I think being conservative is good, but in the back, so if you're going out and talking publicly, going out and telling people, look, I'm just doing a small 50K from friends and family.
I think we're doing it pretty publicly.
Yeah. It doesn't get any more public than this, right? But generally speaking, you could keep some wiggle room for yourself and say, look, if I'm getting really good investors coming in, then what I can do is extend the round a little bit and go up to 300K. The thing that you want to be careful about is dilution. And, it really upsets me when I see really good founders going after, big potential ideas, and they over dilute too early. They, in a lot of cases, they essentially have killed the company because they didn't really do the math and figure out like how much should they dilute and at what stage.
So can I ask a question there? I guess
the
normal rule of thumb is like in a venture round, it's like 20%, right? In this sort of wild west out here, though, is it a range or like?
It is a range. There's no hard and fast rules to go by. So generally, what I like to tell folks is assume you want to dilute no more than 50% by the time you close your Series A. Okay. Now work backwards.
Mm-hmm.
So if you're probably going to get, let's just say 25% at your Series A.
Right.
Now work backwards and say, okay, how much do I have to work with? So at this really, really early stage, I would highly recommend that you try to keep your dilution to no more than 10%, right? And this is for like, let's say 300 to 350K. Try to keep it at no more than 10%. Because you're going to go after an additional 4 to 400K or more later on, right? And you're probably going to dilute again.
Are you saying the 10% for up to that 250 basically, or like? I wouldn't give up 10% for 50K.
Definitely don't do that.
Yeah.
So at this stage, kind of where you guys are at, I think it kind of makes sense for you to say, all right, you know what, this 50K and this 250K is really part of one round.
Right.
And, maybe set like a 4 mil cap and do a safe note on that. Of course, depends on what some of the investors who are coming in, they may come back and say, no, Greg, 4 is too much. Or some might come back and say, Greg, 4 is too cheap. You could easily do 5 or 6.
Yeah.
Right. Kind of taking.
Now, what happens when somebody wants to come in like, well, I know the answer, but just for you to explain, I guess. Let's say somebody's okay with 4, and then somebody comes along later and like, I'm not okay with 4. Right. I wanted it 3.
Yeah. Well, that could be kind of ugly, right? Because, I came in earlier. I took more risk and agreed to 4. Now somebody else is coming along and they disagree, but you really want their money or need their money and you're willing to do it at 3. Well, that's kind of unfair to me. So you have 2 options. Either you come back to me and everyone else who put money in at 4 and say, hey, by the way, let's tear up those safe agreements. We're going to bring you guys in at 3 instead. So here's a new agreement. You're getting a better deal. We're coming in at 3. That's one option.
No one will complain about that.
No one will complain about that, but people will ask questions like, why are you doing this? Did you misprice this in the beginning? Were you, not really paying attention to what market rates were? What happened? Right. And some people may not like that. And they may say, look, I'm not comfortable with this change, right? Is something fundamentally wrong with the business, which is forcing other investors to push the cap down, right? So it could open up a can of worms that you don't want to open up. So the other option is to basically tell the investor who wants to come in at a lower cap, say, sorry, we've already closed money. We've already taken that money from investors at a higher cap. It's not fair. We can't go back to them and change that now. Your other option could be to say, and I don't like this option. I'm just putting it out there so people who want to do this can do this. Say, well, for example, let's say it is, let's say it's a well-known fund, a partner at a well-known fund who's investing either through the fund or as an angel, with the potential of that fund putting money, a larger amount of money in the next rounds, right? So they're essentially buying an option today, right? One of the things that you might be able to do, and it's again, it's tricky and sometimes it's not looked upon very favorably, but sometimes you could come in and say, all right, why don't you come in at the 4 and we'll give you some advisory equity at to compensate for that difference.
This is like a side sweetener.
Yeah, it's generally it's a side letter. You give them some advisory equity, but I think you would, in order to not raise too many eyebrows from folks, is to also be clear on what this advisory equity means, right? You're not just doing this because you want to get them in at a lower cap, or get them in at the higher cap, even though they want to come at the lower cap. So you're just compensating them some way, but actually have a list of things that you want them to actively help you with, and essentially say, look, this is some sort of milestone based vesting on this advisory equity. So that's something that you could do to make it a little bit more palatable to other folks when you do advisory equity like that.
Got you. Okay, I think that sort of makes sense. So in a lot of ways, is it common to not necessarily set the amount you're raising at, or can you have convos not knowing the valuation?
Yeah, you can have. So look, typically you have some venture investor or some investor who sets terms with you, and they'll come out and say, okay, we'll do this deal and here are the terms, right? And one of the terms is the valuation, right? Or the cap. The way things have changed now is that for a lot of smaller rounds and earlier staged companies, there's no lead investor per se. And so you as the founders are kind of self-leading, right? So you're setting those terms and you're basically looking at, say, hey, what are other comparable companies at our stage raising at, right? And if the market rate is, hey, companies that are, first-time founders, product is, past the MVP stage, but no real users or customers, market rate is, 3 million today. And if you're a successful founder, you've had a big exit, blah, 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 you've got a great team, maybe the cap is 10 million, right? And everything else is somewhere in between. So you kind of want to break that down a little bit and look at what market looks like before you go out and say, look, we're going to do this raise and we're going to do it at 5, right? People may come back and say, well, 5 is a little high, Greg, why are you starting at 5? Other people might come back and say, yeah, that's perfect, right? So a lot of it also depends on who you're pitching. If you're talking to folks out in the Bay Area, they may be like, yeah, 5 is perfectly fine. You come out to New York, people are like, whoa,
Denver,
5?
you too, yeah.
Yeah, exactly. So a lot of it also depends on who you're pitching and what the appetite that market has.
That makes sense. Yeah. Okay. Well, we have some more stuff, so I'd love some more feedback.
Yeah.
So we tried to weigh out the pros and cons as well.
Yep.
And I think, what we sort of came away with, and this is sort of and I guess with this, in some ways, I'm kind of curious about how much of this you would normally share, right? With someone. So, we sort of looked at well, what's good about having 50K versus 250K versus 750K? And then what are the things that don't happen sort of as a result of that? And so for us, I think the big thing is our 4th co-founder who we're sort of reserved a spot for. We just need to get to where we can offer him his salary.
Yeah.
And so the big downside, I think, on all of them is sort of that we don't get him until we get to the largest amount that we could raise. Potentially we could do it in that middle tier.
And he needs a full market salary?
He does. Well, not full market for what he'd be worth, but he needs a proper salary, I guess is probably the better way to phrase it.
Okay.
He probably could make $500,000 at Google, but that he's not asking for that. It's just more,
Like, let me put some food on the table and, actually have a life type of money.
Yeah. Well, and this is the thing I think that we've been sensitive to. Like, we're all at varying stages as well, like in our own lives. And, like I've got a wife and family and mortgage, and, Demetrius has a mortgage, and, not a family, he has a cat. And Peter's probably the easiest to sort of manage.
I have no life.
Yeah.
So you're going to be living with Greg, huh?
Yeah, we're technically in my basement right now. So
that spare bedroom's yours.
Yeah. So yeah, I think like we're like, again, like our goal is not to necessarily like have like a heavy head count in the long term. So like we view this money as sort of like being able to like give us like a good amount of runway. So we tried to look at some of the pros and cons of sort of this process itself, and just like what it would take for us to be successful with it. So I think they're fairly obvious, but we do think like, friends and family, there's a less scrutiny, not no scrutiny, right? Like because again, it is in that more of that arena of, we know you guys, we trust you guys, we get the idea that you're going after, and we understand like what it could be, but we don't need you to necessarily like size it and scale the mountain yet. I think once we get to that middle tier, then we are going to need more traction. And so part of this early 50K is, I think, to like help us establish and build and get a bit more traction that hopefully is creating value in the company quickly. Now this is a question we have for later, but I'll bring it up now, I guess, is, and you sort of alluded to some of this, is the people who put in the first 50, do they feel different than the people who put in like the last 50?
Yeah, of course. Right. Especially if it's a long drawn out fundraise.
Yeah.
Right. If I'm the first one in, and you're raising for another 6 months after that.
Right.
And the guy coming in last is getting the same deal that I got. Am I thrilled about that? No, but it's kind of the nature of how things work. So you kind of have to just accept it. But there are things that founders do to kind of sweeten the pot a little bit for early investors. And sometimes it could be advisory equity with some caveats. Other times it could be like, hey, maybe if it's somebody that can actually help with certain things, like, maybe they're a designer, right? Maybe you could say, hey, we'll bring you on as an advisor, and, we'll throw in additional equity as you help us designing out the product. There's other things that you could do to kind of help them along. Sometimes there are also contractual sweeteners. So it's like, look, if I don't raise money within a certain amount of time, your cap is going to drop, right? So we're starting you out at 4, but if I don't raise money in 3 months and I don't raise a certain amount of money in that time, your cap will drop to 3. And, so you're essentially getting more equity because you took earlier risk. And what's that?
Yeah, just curious. So in a safe, it would be that same scenario of like, well, we're going to tear up this agreement and reissue a new one at a lower cap.
Well, no. In that particular case, I haven't seen those in safes, but I've seen them in convertibles, and I've seen them in price rounds where, people will put a formula that basically says, look, we are going to raise $500,000, and you might be the first 100K coming in. Mm-hmm. So if we don't raise the other 400K within 3 months or 6 months, then you will get a additional amount of equity based on this formula, right? So there's no new agreement.
Gotcha.
That agreement has it spelled out. I haven't seen that in a state. Is it possible to put in? I'm not a lawyer, but I think yes, that language could be put into a safe agreement as well, so you don't have to actually tear it up and go through that process again. And somebody's like, oh, I didn't get the paperwork, and it's 2 months before they sign again, right? So you could build something like that in for the first few people that come in, right? So if you want to incentivize folks to make a decision quickly and wire the money quickly, you can throw some of those incentives in and say, for the first 50K or first 100K that comes in, we're going to guarantee that we're going to raise a certain amount of money within a certain amount of time, and if we don't, you guys get a little bit of a top up on your original investment, right?
Yeah, right. Okay, that makes sense.
So you could do stuff like that.
Yeah, we'll probably have some questions for you when we get there.
Mm.
So we also then like kind of, you know, just in anticipation, this is sort of how we expect or how long we do think we get. You know, again, I think this would probably be reflected in that more spreadsheet oriented view, but just for people to understand, you know, we anticipate that sort of early 50K to give us a few more months, but we do think we can do a lot with that.
Yeah.
Then that next batch of money should actually give us a decent amount of runway.
Yep.
And you know, advice we've been given and many times in the past, I'm curious what you agree with or think about. You know, a lot of people say like about 750 is kind of like a good number. It's usually like a year to 18 months of runway, depending on like how your company is configured and spending.
Yep.
You know, does that number seem right? And then I also know you'd mentioned something. I think it's worth you bringing up maybe a little bit here. Like based on like the current like financial environment or like fundraising environment right now, like, you know, are there other things maybe to think about?
Yeah. So, you know, I think making 50K last 3 months is great. 250K 6 months, sure, makes sense. 750 12 months, you know, a lot of that really depends on where you are. If you're in New York City, that's not going to last you 12 months. If you are in the Bay Area, probably not. In Denver, yeah, it could. Some of it also comes back to who you're raising from, right? You might be able to raise $1 million from folks in the Bay Area, and you know, have 12 to 18 months of runway, and still give up the same amount of equity, right? Because the expectation, the market, everything is slightly different in the Bay Area than it is in Denver and New York, and you know, so every geography has its own little nuances.
What do you do when you have mixed investors? And I guess like if I've got SF investors and Denver, are you like, what's wrong with you guys? Like, you know?
I think, and you know, I don't know if this is necessarily the right answer, but it's kind of the best answer. I think for most situations is go with where the bulk of the money is coming from,
right?
And whoever's
right.
Yeah, and whoever's writing the largest check, right? So like if your largest check is coming from the Bay Area and they're perfectly fine with those terms, you might wind up inadvertently shutting out some folks from Denver who are used to slightly more investor-friendly terms. So you might shut some of them out, which means now you're going to have to continue raising from the Bay Area. But, you know, there's no right or wrong answer, really. It's kind of like a lot of it comes back to who you know and, you know, who's excited. And, you know, you might have folks in Denver who'll be like, look, as long as you have a big check coming in from the Bay Area, I'm fine coming in at the same terms because I know those guys are going to help carry you at the next stage, right? So they understand that, you know, they're not going to be able to help carry you at the next stage because they're in Denver.
And as much as this is, there's norms, it's also still market dynamics. Right? Like,
absolutely.
Like what can you get to work?
100%. And you know, from a macro perspective, right? Like looking at what's happening at the macro level is important to kind of stretch out your runway, right? Because if you think that the funding environment is tightening because, you know, most tech IPOs are bombing, you know, it's eventually going to trickle down, right? From the IPO stage onwards to seed stage, you know, slowly everyone's going to start tightening their purses a little bit, or at least looking for better deals, because now there's a little bit more risk in these companies exiting and the investor making money. So that could eventually trickle down. Now, if you look at it and say, well, you know, I think, you know, Series Bs are getting harder right now. You know, people are still raising a large amount of money, but dilution is higher than it was 6 months ago. And it's taking longer to close that round. And now you start seeing a little bit of that happening at the Series A. You know, sometimes there are false positives that occur right now. If this U.S.-China trade deal gets resolved, as they're saying it might, is that going to change the IPO market, right?
Hmm.
It's hard to tell. So, just, I wouldn't say dive into it too much,
Right.
but, think about it a little bit and say, well, in the event that things go wrong in 6 months or 8 months, we're raising for 12 months right now, but can we extend that out to 18 months to kind of weather the storm, right? So you may want to leave a little bit of buffer room for yourself. And if you go back to that slide where you say, hey, 750 is going to last us 12 months, you might want to say, you know what, let's push that up to raise $1 million in the event that the market conditions change and they're more adverse than they are today. We might have to extend that runway for 18 months instead of just having 12 months. So 250K may not give you exactly 6 months, but between having that extra buffer and cutting some costs somewhere, you might be able to extend it long enough that you can get to that next round, that later round.
Yeah, hopefully if we're spending it faster, it's for the right reason, right?
Yeah. But sometimes things get weird, right? Yeah. And even if you're spending that money for the right reasons, under good conditions, nobody will care. But if overall there's gloom and doom everywhere, people would be like, well, I don't care. You're spending too much money too soon. And that could hurt you. So,
yeah. I think this is my second to last slide, but I guess it's more about in the communication process with investors. Peter and I were talking about this the other day. We weren't sure necessarily like what metric, like what do you peg the funding to? So there's obviously time, like how long of the runway it creates for you, right? But do you want to tie it to like we're going to have X number of users by this time, or is it like we sort of like laid out an approach here more about like where we believe the product will be evolving to, right?
Yeah.
And from here we would then be able to like, but I feel weird about it because it's all guessing, right? Like how many users from knowing the product we plan to have, then we might be able to say like, this is kind of the usage we anticipate to happen.
Yeah.
But honestly, that'll be BS no matter what we say as far as.
Yeah. So I wouldn't go down that road.
Okay.
What I would try and talk about is stuff that you can control, right? You can control product delivery. You can control, team size, who you're hiring, what your roles are going to be, and some of those are tied directly to where the product is going to be or going to need to be, right? I think at this stage, it's really hard to say, yeah, we're going to have, 20,000 users, or we're going to target having 20,000 users. You don't know whether that's really possible or not today, because there's just a lot of various moving parts that you have to try and control for. So what I think you want to do specifically for this 50 to 250K is kind of say, look, we want this money to be able to launch a revenue ready product. We've got a couple of beta or alpha testers. We want to use this to convert them into paying customers and start identifying additional paying customers, right? So something along those lines where it's a little bit open-ended, but it's not super vague. There is a milestone. There are targets that you're setting for yourself of what you want to achieve with this money. And it's something that an angel investor that is active can relate to and say, yeah, okay, I get it. You need to hire a couple of engineers. You need to hire a designer or a contractor, and it's going to cost money. So you need some money to pay these guys to get the product to that point. Okay, fair enough. Right. So this ties back into what we were talking about, I think on the last episode about large market, right? So if the market seems large enough and you can get the product out quicker because you're raising this money, that ties in and it's like, yeah, okay, I get it. You can start attacking this market faster if you get this 250 to 300K right now to get the product to that point. So it's less about customers right now. It's more about product and start seeding the idea of the product with potential customers.
Right. Okay. And you think that that's a fair use through like that first 250?
Yeah, for that first 300, or in some cases even up to the first 500.
Okay.
Right? That could be fine. You got to tie it into, again, your product planning, like when you plan to get the product to the stage, as well as your funding, and say, okay, well, how are these things lining up? If we know that we need to hire an additional engineer in 6 months, is it because we just think that's the case, or no, we plan to have our product out the door in 4 months, and we're going to need additional engineers to kind of help optimize it as we're bringing on customers. So that's why we think we're going to hire another engineer in 6 months. All right, so that kind of aligns up, and you can explain that to somebody if somebody wants to dig into that much detail. But I don't think most angel investors will want to dig into that detail. They're going to rely on you to dig into that detail.
Yeah.
So that's a good exercise for you.
So to be clear, you think angels may not get even that weedy?
I don't think so. I don't think most angels will go into that level of detail, because again, it comes back to what we were talking about before. This, first, let's say 500K is not about the numbers. It's about the people. Mm-hmm. It's about like, hey, Greg, are you and your team capable of doing this? Is the market large enough opportunity where it's worth you guys doing this, and it's worth putting money into?
Yeah.
And do I believe that you can execute on this? If the answers are yes, then it's more about that now. It's fair. Less about, this is a beautiful product, everyone's going to want to use this, and you've got money coming in the door. It's less about that right now.
Okay, that's good to know. I feel like a lot of the advice is in a lot of ways conflicting, because everyone's like, you need traction to raise money. Well, it's like, if I had traction, I probably would be making money, right? Like, and so it is
look, the ideal situation is to go out and raise money when you don't need it, because you got money coming in the door, and now it's more about raising money so you can accelerate that, right? So you are going out and raising money because you need it, and that does make things a little bit more difficult, for sure.
Right. Absolutely.
And yes, a lot of the advice is going to be contradictory, because people have different networks and different experiences, and they see different things, right? So just because I see something doesn't mean it's the same thing that somebody else in Seattle is going to see, or somebody in Bangalore is going to see.
Yeah,
it could be very different, right? And we give advice based on what we see, but also what we hear and read about. But it's it's hard to say, look, this is the best way to do this.
Yeah, sure.
That the best way to do this is going to be tailored to, okay, who are you talking to? Who are these people? How, if you've known somebody for 10 years, you've done 2 startups with them. If they're not going to write you a 10K check, I want to know why they're not writing you a 10K check, right? If they've made money with you in the past, I would expect, a 5 or 10K check wouldn't be a big deal for them to write, right? If they are active investors. Yeah. If they're not active investors, it's a different story. Right. But if they are active investors, writing a 5 or 10K check should make a lot of sense. So some of the things that you're going to do is going to be different than a first-time founder is going to do. And I think we had a question from somebody about,
we did.
Yeah. Oh, I see it. How does a founder coming from nothing bootstrap until the company becomes investable, right? For Rahul, so, his question, and the answer to his question is going to be a little bit more complicated. The answer to your question is going to be a little bit easier, right? Because you have certain networks, you have certain experiences and pedigree, and a team where you can go in a certain direction. His direction might be very different, and it's hard to answer his question in a very general fashion, right? So that's why I think answering a question like his is going to have to be, well, let's talk, let's get on the phone, let's get some background on who you are and where you are and what you're doing, and then let's figure out like what makes sense for you, right?
And I do think we can do lots of talk, or we can have a separate show at some point about just ways you can bootstrap. But
would you recommend first trying to make money by contracting, or doing something on the side, or do you think it's gonna kind of go against the potential of the startup, like just wasting time on something that's not productive?
So that's one of those things where there's no right or wrong answer. If you have raised money from investors, I wouldn't suggest doing that, because investors are going to say, look, I gave you money to go do this. Why are you trying to earn money doing something completely different?
Right.
Because you're not doing what I gave you money to do, and I'm not happy about that.
Yeah.
so investors are not going to be happy about you going out and consulting after you've raised money from them. Instead, what you may want to do is go back to them and say, look, we need more money because we have to do X, Y, Z. We didn't right size the amount of money that we needed initially. So we need more now. And they're not going to be happy about that. But if you say, look, our options are either to get more money from you guys or go out and consult, I think most investors will say, all right, we'll try to get you some more money. May not be all the money that you need, but a little bit. Right. If you haven't raised money, the question is now, all right, is it easier for you to go out and get those consulting agreements, make enough money, and then work on the product? Or are you doing it simultaneously? Like, hey, one person's out consulting while another three are working on the product. That becomes more of an internal team dynamic that you guys have to figure out. Like, how are you going to manage that? And is it going to slow down the timelines that you're thinking about in terms of going to market? Right.
Yeah. It becomes like it's just opportunity cost, right? Sort of associated with, with each pathway, I guess, ultimately. Right? But yeah, I do think that is a problem. Something definitely worth considering. We had some questions which, Rahul, I think as Pankaj said, it's probably not an easy answer to be able to say. There are lots of ways to bootstrap, however. If you have this skill, you should be able to bootstrap. This is why most companies don't get started. People talk about starting companies for years and years because they can't really figure out how to do their job. And so in some ways, the first test to an entrepreneur from an investor's point of view is, how hard are you willing to work? How ingenious are you going to be about getting even to the point of having an idea or a concept or whatever that is fleshed out, that is thought about, that is, sort of grokkable, right?
Yeah.
And having the means to start delivering on that.
Yeah.
To kind of prove that you can build something useful.
Yeah. Yeah. I mean, look, bootstrapping is never easy. And, for a lot of people, you really need a strong social support structure to bootstrap, right? So, if you are two young folks, living in the Bay Area, it's a lot harder to bootstrap because just the cost of living is so higher. But if you are three young founders living in Vietnam or India and other places, you could bootstrap because you have a family support structure that will allow you to do so. Mm-hmm. You may not have the money that you need to spend on marketing and hiring people, but at the very least, you don't have to spend money on putting food on the table or rent in a lot of instances. So that makes a big difference. That allows you to start banging on that keyboard and build out a product and hustle, right? Maybe you'll do some consulting on the side, bring in a little bit of money to spend on, whatever contractor or marketing if you need to. But, I've done enough investments in startups in India that, their biggest claim to fame is we achieved this milestone and this much traction with zero marketing, right?
Yeah.
Okay. So, there are plenty of companies, especially in places like India, that have marketing. They haven't spent any money on marketing and they have some traction. So, there are ways to bootstrap, but like we said before, I think, Rahul, your question has to be more of people have to understand your particular situation, right? And then be able to say, well, these are things that you could do. I think, Greg, you've answered a bunch of things, Peter, you too, like consulting and everything else that people can do to bootstrap, but a lot of it is, personal. You gotta figure it out in your situation.
Yeah. As an anecdote, when we started Shoot, it was kind of interesting. We'd raised some, you remember Lilgrams.
Yep.
We'd actually raised some angel money to go add like book printing or some other capability into Lilgrams. And we came back from my wedding, I think it was, and we're like, I have an idea. And it was the photo part of it. And so we went back to all of our angels and pitched them and said, look, so either you can have your money back or we want to go do this thing.
Yeah.
As an and it was really like a pivot out of like a subset of what Lilgrams was. everyone agreed and actually moved their money into Shoot, what became Shoot. But it just shows you, like, if you do know what you're doing, with that, like, I think it was like maybe 50 grand we had at that time. Like in 54 days, we went from like literally nothing. Like I was doing like randomly asking people at the Ace Hotel in New York, like, so what do you think of this idea? Like to get feedback on like, doing user research at the Ace right after New Year's, to we had an API, a front end, a Chrome extension, a desktop app, and launched at the first launch conference, like on stage.
Wow.
Right. Like in 50 days. And it's really about, yes, we had some money, but most people wouldn't have done the same with that amount of money either way. Right.
Yeah.
Like they would have like barely gotten anything done, or they might have hired one person. So it's really about how resourceful you can be with whatever amount of thing it is. And this is in some ways why, like, I really like having like the co-founders I have, though, is that we already are very capable unto ourselves. So that I think that gives you the kind of advantage. But the first signal is, if the idea is bigger than what your normal skill set is, can you recruit anybody to work with you on it? Right. It's sort of like step zero.
Yeah.
Like, because these are co-founders, but eventually you have to like actually convince employees or other people who you're not giving like, significant equity in the company, like to actually come and work with you, and
for below market salary.
And for below market salary and a whole bunch of other things. Right.
Yeah.
So yeah, I do think it is interesting. We are just about up on time. So I just want to say thank you once again. Thank you, Pankaj. This has been great. I think we actually answered most of our questions that we had. We sort of drizzled them out, but I wanted to put them up here just in case. If you do have questions, by all means, you can still send us those in the comments or wherever you like. You can email us at raise@foundercraft.com, or head over to our site where you can find all these episodes and everything else. Just to summarize where we are today, though, this was episode 102. Up next, I believe it's Monday at 10 a.m. Mountain, 12 Eastern. We will be talking about the checklist, about what you need to do before you go out to raise. So this will be like a lot of us asking questions of Pankaj instead, like, so what do we do with that? Or why do we need that? Or what goes in that? Right. But it'll be another good or fun experience, I think. And it is another step in the process of getting ready to go out and fundraise. So thank you very much. Have a great weekend, everyone. We hope this was useful and informative. By all means, send us your questions if you do have them. If you want to bookmark or add to your calendar any of the future episodes, head over to foundercraft.com/raise, and we've listed them all out for you. And it's been good to chat today.
Have a good weekend, everyone. Thanks.
All right. Bye, everyone.
Take care.